so much is happening in terms of global finance. Financial technologies plays a very pivotal role. Look at the uncertainties in the world. Globalization has been challenged now. We have financial instability coming in. Banks are collapsing in US, interest rate hikes. And again, the global risk is very high. Now, technology is the centerpiece of the overall game, because technology converge with a business. Unless you redefine yourself with the changing face of the world, you cannot be in business. Conference like this is bringing financial technology to the region is paramount. You saw yesterday, you have the bank CEOs, technology experts, venture capitalists, regulatory authorities were all converging on one substance: how to make sure the global economy is stable and functional in the uncertain world. So this kind of seminars and conferences are vital for us to see through, knowledge pick, and then move forward. Absolutely, it is important. The FinTech converging with the financial service is a bigger opportunity, but they are not regulated. They are not having the set of standards for public risk management. When it comes to a bank, you have global norms. Whether you are running a local bank or a private bank, it is global and it is public. Whereas with a small capital, you can have innovation and you can do a financial service. But to establish trust and confidence, you have to converge. And that's what precisely I managed to execute during my tenure in running enterprises, financial enterprises. I work with development banks. I bring in the cost of capital cheaper for the fintech companies. I make sure innovation stays, but the bank is in the forefront of converging and then promoting the value-added service. It is useful for captive support for the bank as well as the customers. So customers see a value in it. It is not a competition for the banks. It is a collaboration in substance. That's what every financial institution should aim at, collaborating it and making sure create a win-win model. See, the changing face of the world has created enormous amount of disruptions. Disruption does not mean only it's technology disruptions. Now we have seen post-COVID, uncertainties are mounting, global risks are multiplying, and we have seen recently with the interest rate hike from disinflation to inflation, and inflation again, to contain the inflation, interest rates are going up. In the process, the enterprise risk integration was not taking place, whether operational risk or credit risk or market risk or even technology risk. So what we need to articulate is to recognize these challenges. Now we have seen 3 banks in the US collapse, Signature Bank or Silicon Valley Bank. So we have reasons to believe technology is a tool where you can have predictive intelligence. It's measurable, manageable, controllable for larger purpose. So the technology model has to be, you should do it to make sure that it's restructure your business and again articulate solutions which are more responsive to have financial stability. And that's what good institutions should do. So you need a knowledge breakup, seminars like this, understanding the risk and mapping the risk into business process, ensuring technology plays a pivotal role is the opportunity for us to redefine your business. We have had a systemic and contagion risk. What's happening in one part of the world resonates the rest of the world. What's happened on the Silicon Valley Bank had impacted the rest of the world. So banks are running with lesser capital. So capital adequacy needs to be briefed up. With the change in face of the business model, there was a huge amount of risk and again allied cost. So that's precisely happened to Credit Suisse. Credit Suisse collapse was a major distortion, and again, personally, I don't agree with what Swiss authorities have done, wiping out 17 billion additional Tier 1 bond. Again, so now there is a merger between UBS and Credit Suisse. That has distorted the confidence in the European systems. Having said that, ECB, European Central Bank, distanced from the Swiss authorities, and they said they will honor all their commitments in terms of tier 1 capital. So this has got impact around the world in terms of additional tier 1 capital. So the bonds, there is, with the interest rate hike, there is a diminution in the value of the investment, overall investments, but fixed income securities are safer in today's context, even otherwise. When it comes to Gulf states are oil and gas. 45% of the world oil, 25% of the world gas come from this place. So essentially, we have bigger opportunity to be more stable. If you look at all the Gulf states, including Saudi Arabia, in aggregate terms is going to run between 3.5% to 4%, and they are all likely to run in fiscal surplus. So that is the opportunity, because oil price is costing over $80 now, Brent is, and again, US crude is around $75. So our current account surplus, fiscal surplus is going to be a major opportunity. Plus, government is also interested in spending huge amount of infrastructure creation. Saudi Arabia is in the forefront. Again, UAE is going to do around 4% growth, aggregate terms. So all the Gulf states are stable financially, and there is a good response in terms of even initial public offering. Recently, Abu Dhabi ADNOC has come out with. So plenty of reasons to believe this region is safe, whether it's equity, whether it is fixed income securities. Banks are stable, they are well capitalized, they are making good earnings, and price to books is cheaper. So this is the time to invest in the Gulf states.